Well, hello everyone, and welcome to Legal Futures Reporting Chargeable Events in Trust webinar with me, Gill Steel of Law Skills. Now, one of the strange factors in tax is that sometimes you have to report the occasion of charge even though there's no actual tax to pay. And that's because you might have allowances or reliefs or even exemptions that can bring the tax bill down to zero. However, that is the point. If HMRC was not made aware of the chargeable event in the self-assessment system, then they wouldn't be able to check whether they agreed with you about the allocation of those allowances, etc. And obviously, it's an opportunity for them to check valuations as well. Clients, of course, don't like paying, especially when there's no tax to pay. But really, they should be pleased, since if confirmed, they can easily then have fully disclosed the facts, and having claimed the right allowances, their tax affairs are in order. Job done. So in administering trusts, practitioners need to be aware of chargeable events, and basically that's what this session is all about, because my aim is several-fold in this occasion. Firstly, it's to remind practitioners of the chargeable events in the life of the trust, just from an inheritance tax point of view, to help practitioners master when to report them to HMRC. And the fact is that although there are a number of chargeable events, there are a couple that I won't be covering, which is cessation of conditional exemption, which some of you will know is where people have inherited property of significant interest to the public, so stately homes and contents and that kind of thing, or chargeable events in respect of alternatively secure pensions, as these are not usually things that most practitioners are dealing with. So as a result of taking part today, practitioners will be able to distinguish between chargeable events which do need to be reported and those which do not. So let's dive in. I'm going to ask the question, what is a chargeable event? And basically the list that I'm going to cover is lifetime gifts that go into trust, ending an interest in possession trust, discretionary trusts, or really any trusts that are within the relevant property regime, assets leaving an 18 to 25 trust,